The richest man on the planet just loaded up on his own company stock for the first time in 5 years. But why now? Why this timing? Is it because of what Jerome Powell is going to announce here in the next 2 days? Or is it because of what Donald Trump is hinting at and Elon knows something relative to the new policies coming forward potentially in the SEC and filings? We're going to go over all of that. But first, we need to go over the man, the myth, the legend, Elon Musk buying more of his Tesla shares. So he bought 1 billion in the sign of confidence of his in the EV maker, which I think is hilarious. Like, why wouldn't Elon ever be confident in his own company? I have no idea, but that's what this headline says. So they bought 2.57 million shares worth about a billy, like the goat here. And so they've been purchasing a lot of Tesla shares since and the first time since February 2020. So, of course, February 2020, something happened crazy in March 2020, but buying these 1.9 million shares priced at about 371 to 396, with that nearly being $1 billion, it begs the question, why is Elon buying this stock now? Well, there was a unique announcement from Donald Trump, or at least hinting at something here fairly recently. He came out and said that he wanted to get rid of quarterly earnings, saying that all public companies should not need to post their quarterly earnings. Now, I think that's very interesting when you look at everything here going here, right? They should report twice a year, every 6 months, opposed to every quarter like it has been. But Trump mentioned how China does a 50 to 100-year view on companies. So he's really comparing and contrasting the way that the United States reports companies to how China reports companies. Obviously, the United States has the most open and honest economy of any of them here globally. But it's interesting that he looks at it this way, because why would we want to downgrade it and not want to be more open? In my opinion, I would think if we have a publicly traded market, we would want more transparency, but it seems like he doesn't want that. Now, since 1970, all publicly traded companies have been required to file quarterly annual reports. Now, I think this might be a step backwards, because we do have other companies and, in various industries mention things almost weekly, while we do see, guys like Michael Saylor and MSTR. I mean, he announces Bitcoin buys, granted, but he does this every single day or every single week. And they have a fully transparent outline of all of their different stocks, metrics that you could potentially want. They have all of that right here on their own company website. And then they've even got, Stride, like all of their, various debt goods that they got, preferred stock offerings. They have that all there. And you can go to that right there. So when you're looking at this, they're like, hey, is this the right approach? Because there's only 5 countries in the world that require quarterly earnings: US, Canada, Japan, China, and South Korea. But the proponents say it promotes transparency, and I think that it does as well. And I hear the argument that says it makes the companies too short-term oriented, because you want to have that transparency there, but companies can make drastic decisions relative to how much we have going on, like here, right? I mean, you want to make sure that your quarter is looking positive, and instead it's not looking necessarily for the longer outlook of the investors. But I think, we should have some transparency. Granted, that might see some more shifts in the overall stock. It might put some more volatility in there. But I think having a fully transparent system really gives confidence in the investor. Now, if the investor goes and buys a stock and doesn't hear anything for 6 months, what is he supposed to think, right? I think that we should have a more transparent market. And if you look at Europe, before 2013, the rules required quarterly earnings. After, what happened? Well, first, very few companies actually stopped reporting quarterly earnings. And in the UK, 45 of the 471 stopped doing quarterly. All stoppers had the same characteristics: small market caps, and did not provide guidance. However, over the next few years, liquidity suffered in these firms and they cut back on quarterly results. So, I mean, we've seen this happen in history before. Granted, the market is much different in UK as it is in the United States. But if we see this, right, slow down, are we going to see the liquidity dry up for many of these firms? Now, I think that's where we have to continue looking on. Now, in their view, here in the Kobayashi letter, it would need to be required to be effective. When it's optional, equity risk premiums rise on companies that report less often. Simply put, you are taking on more of financial risk when you have less information about the company. Now, I think that that's what you should just take from there as it is. If you're less transparent, investors are going to be less confident in investing in your company. Plain and simple, full stop. We've already seen it. Examples of this in history. And history doesn't always repeat, but it does rhyme. So when this happens, well, why would we go to this when we've already seen this, right? It's not a huge cost effective strategy. It would save a little bit, but in reality, he also went back to this in 2018, where he said we should study how a 6-month impact would be. But today is the first time that Trump mentioned this since then. And then we also have Elon buying a bunch of Tesla shares, seeing it go from about 69 to $420. Now, with this, right, I think it's interesting seeing how much we've seen the buying go up, especially when we have, the rate, potentially the rate cut coming in 2 days on Wednesday this week. Now, we have a 96% chance that it's just going to be a 25 basis point cut. But I think, that this 4% chance of a 50 basis point cut, I think that speaks volumes. I think we need to definitely increase. And I think we should continue to watch how this goes. Now, when we're looking at the amount of consumer and how they're looking at inflationary aspects, you got to ask yourself, is the economy ready for rate cuts? Because to be quite honest, I don't necessarily think that we are. I mean, if you look at everything, we've got 7 in 10 Americans think their income will not keep up with rising prices over the next 1 to 2 years, the highest share in at least 30 years. By comparison, in 2019 and 2020, only 3 in 10 adults expected this, but 7 in 10 now. So literally over double. Now, this is well above the 2008 financial crisis and the post-2008 average. Additionally, consumers expected increases in inflation and adjusted income over the next 12 months. The majority of Americans expect their inflation to continue eroding their wealth. Well, would you look at that? Even when we get the markets at all-time highs. I mean, the 6,600 mark for the S&P 500 is the highest levels that we've seen. And it's continuing to go. And I'm tracking all of this, including the currency debasement that All Nighter Hider is saying in the chat. So make sure you guys are hitting that subscribe button to join with him. Because if you look at the currency debasement, right, you just look at the overall strength of the dollar. We're at 97.2. We haven't been above 97 in over a month. In fact, we're actually down in a month, right? So, and over this 5-month period, look at how red this is. This is literally the worst start to a year for the dollar since 1973. We went off the gold standard in 1971. So this is since the dollar basically became a fiat currency and was not gold backed. This is the second worst year. This might even be inching towards the worst start to a year ever, the worst year ever for the dollar. Now, this was back in July that we said this, this is the worst start to a year since 1973. So, I mean, if you look at this and you compare it to 1973, we had stagflation in the 70s. And I've been covering this very closely. And I've been saying basically the 1970s look very close to right now. So 1973, the CPI, the consumers were about 44,000. Now it's 323,000. This means that something that cost $1 in 1973 would cost about $7.28 today. So the dollar is literally in the biggest bear market of all time. Brent Johnson calls 90 to 110 a pretty average range for the Dixie. Yeah, I mean, that low 90s, like we don't really want to see that. For being honest here, all nighter hider, we want to see the dollar dominate, and we aren't necessarily seeing that. So we're seeing, the dollar go lower, and then the comparison between the 1970s, well, the inflation rate has been 627% since 1973. The dollar has lost a lot of purchasing power. So the dollar versus major foreign currencies has had a 10 to 11% decrease in the dollar index. So against all other fiat currencies, we're seeing the dollar just get absolutely kicked in the teeth. And so if the dollar is depreciating, and then we have Elon Musk flocking towards Tesla stock. I mean, what happens when you see interest rates get cut? Big tech, they absolutely take off. So Elon knows this is coming, and he was preparing for it. They were essentially cutting interest rates because he is anticipating a big old run for Tesla and others. So as we see Tesla skyrocket in flight, make sure you guys are hitting that subscribe button for me. But either way, we're seeing Elon take off, man. Like, he is going to continue this buy. He's going to keep pushing it. And I think that we're going to continue to see just how long the US stock market can hold on here. If we see the potential of a crash, will they open up the floodgates even more? I've heard others basically say that we need a 50, 25, 25, but it looks like we're going to get a 25 basis point cut here Wednesday. I'm going to be covering all that, so make sure you guys are subscribing. I'll go live right after the decision, and make sure you guys are tuning in for more, and I'll catch you guys all at the next one.